investment myths survive for one simple reason: they sound reasonable, especially when repeated often and supported by selective examples. Over time, these myths harden into common sense, guiding decisions quietly and persistently, even when evidence contradicts them. Debunking investment myths is not about winning arguments or sounding sophisticated. It is about removing hidden assumptions that distort behavior, because in investing, what you believe to be true often matters more than what actually is. One of the most enduring myths is that investing is about intelligence. People assume that the smartest investors, those with the highest IQs or most advanced mathematical skills, will naturally outperform. In reality, investing success correlates far more strongly with temperament than intellect. Emotional control, patience, humility, and consistency matter more than clever analysis. Highly intelligent investors often struggle precisely because they overestimate their ability to predict outcomes and underestimate uncertainty. Markets do not reward brilliance. They reward survival and discipline. Another common myth is that higher risk always leads to higher returns. This idea is partially true in theory, but dangerously misleading in practice. Risk only leads to higher expected returns when it is compensated risk, not when it is avoidable, misunderstood, or concentrated. Taking on leverage, chasing speculative assets, or ignoring diversification increases risk, but not necessarily returns. Many investors discover too late that they took risk that markets did not reward. The myth persists because people remember the few who got rich quickly and forget the many who disappeared quietly. The belief that you must time the market to succeed is another powerful illusion. This myth convinces investors that waiting for the perfect entry or exit is essential. In reality, market timing requires being right twice consistently under emotional pressure. Very few achieve this over long periods. Most long-term wealth is built by time in the market, not timing the market. The damage from missing a handful of strong recovery periods often outweighs the benefit of avoiding several downturns. Timing feels proactive, but it often results in paralysis or poor execution. A closely related myth is that cash is safe. Cash feels stable because its nominal value does not fluctuate. But stability is not the same as safety. Inflation quietly erodes purchasing power over time. For long-term goals, excessive cash is often one of the riskiest positions because it guarantees a loss in real terms. Cash has a role particularly for liquidity and optionality, but treating it as a long-term investment strategy is a misunderstanding of risk. Many investors also believe that diversification limits returns. They assume that concentrating capital in their best ideas is the path to superior performance. Concentration can indeed amplify outcomes, but it also amplifies errors. Diversification is not about maximizing returns. It is about reducing the impact of being wrong. Over long horizons, avoiding catastrophic mistakes often matters more than capturing extreme upside. Diversification is a tool for endurance, not mediocrity. The myth that past performance predicts future results is so persistent that it appears in marketing despite regulatory warnings. Investors naturally extrapolate what has worked recently into the future. This recency bias fuels bubbles and disappointment cycles. Assets, strategies, and managers go through phases. High past returns often signal crowded trades and elevated expectations rather than future opportunity. Understanding why something performed well matters far more than how well it performed. Another deeply ingrained myth is that professional investors always know more. While professionals have access to resources and experience, they are still constrained by incentives, benchmarks, and career risk. Many professional decisions are driven as much by reputation management as by conviction. Individual investors who assume professionals are always right often outsource judgment without realizing it. Skill exists, but it is uneven and difficult to identify in advance. There is also the comforting myth that complexity equals sophistication. Complicated strategies, exotic instruments, and intricate models can create the illusion of control. In reality, complexity often increases fragility. Simple strategies executed consistently outperform complex strategies executed inconsistently. Complexity should only be introduced when it solves a specific problem, not to signal intelligence. Perhaps the most dangerous myth of all is that this time is different. Every cycle produces convincing reasons why old rules no longer apply. New technology, new policy, new paradigms. While the surface details change, human behavior does not. Fear, greed, and overconfidence repeat relentlessly. Investors who believe they are witnessing a permanent exception often abandon discipline just before consequences appear. What makes investment myths so powerful is that they are emotionally appealing. They promise control, certainty, or superiority. Debunking them feels uncomfortable because it replaces excitement with responsibility. Yet this discomfort is protective. Investors who question common myths early make fewer irreversible mistakes later. The goal of debunking investment myths is not to become cynical. It is to become realistic. Markets are complex adaptive systems driven by human behavior. Simple stories rarely survive contact with reality. Investors who build their approach on evidence rather than folklore gain a quiet but durable advantage. As investing information becomes louder and more persuasive, myths spread faster than ever. The challenge is not finding information, but filtering belief. Knowing which ideas sound good, but fail in practice, and understanding how those ideas influence behavior over time is where real learning begins, because recognizing a myth intellectually does not automatically prevent acting on it emotionally. And learning how to replace myths with durable principles is exactly where we need to go next, by examining how to replace seductive investment myths with durable principles that actually survive market cycles. Because myths fade only when something stronger takes their place. The first replacement principle is accepting uncertainty rather than fighting it. Markets are not puzzles to be solved once, but environments to be navigated repeatedly. Investors who stop demanding certainty free themselves from the need to predict. Instead of asking what will happen next, they ask, what can go wrong and can I survive it? This single shift dismantles many myths at once, because most myths promise control in a system that doesn't offer it. The second principle is prioritizing process over outcome. Myths thrive on outcome worship: who made the most money, who called the top, who bought the winner early. A durable investor judges decisions by whether they followed a sound process aligned with long-term goals and risk tolerance. This does not eliminate mistakes, but it turns mistakes into tuition rather than trauma. Over time, process-focused investors compound judgment as reliably as they compound capital. Another essential replacement is redefining risk. Instead of equating risk with volatility, durable investors define risk as the probability of permanent capital impairment or failure to meet life goals. This reframing exposes why many myths are dangerous. Market timing increases goal risk. Concentration increases ruin risk. Excess cash increases inflation risk. When risk is defined properly, many safe ideas are revealed as fragile, and many boring ideas reveal their strength. Humility is the antidote to the myth of superiority. Investors who assume they are average behave more intelligently than those who assume they are exceptional. They diversify. They size positions modestly. They expect periods of underperformance without abandoning strategy. This humility is not self-doubt, it is statistical realism. Markets punish ego quietly and reward modesty slowly. Replacing the myth of complexity requires valuing robustness over elegance. Robust strategies work across many environments, even if they are not optimal in any single one. They leave room for error. They survive bad luck. Simple asset allocation, regular rebalancing, cost control, and patience outperform elaborate schemes precisely because they tolerate human imperfection. Complexity that cannot survive misuse is not sophistication. It is fragility. One of the most powerful replacements is aligning investing with life rather than identity. Many myths persist because they flatter the ego, being smarter, faster, earlier, braver. Durable investing shifts focus away from comparison and towards sufficiency. The question becomes not how do I beat others, but how do I ensure this capital does what I need it to do? When investing stops being a scoreboard, myths lose much of their grip. Finally, durable principles require reinforcement through structure. Rules, automation, diversification, and written plans exist to protect investors from reverting to myth-driven behavior under stress. Knowing the truth is not enough. The environment must be designed so that the truth is easier to follow than the myth. This is why successful investors look boring in action and resilient in results. In the end, debunking investment myths is not about memorizing a list of false beliefs. It is about replacing emotionally appealing stories with principles that respect uncertainty, human behavior, and time. Myths promise shortcuts. Principles demand patience. Markets reward the latter far more reliably than the former. If this discussion helped you recognize which myths may still be influencing your own decisions, consider subscribing to stay with these long-form conversations focused on replacing illusion with structure, and leave a comment sharing one belief you have questioned or changed over time, because unlearning is often the most valuable investment skill of all.